Today's lesson will be Chapter 10, Problem 11-5B. So if you'll hold on with me just a minute, I'll get us started. I'm going to start by sharing our screen. And you should be able to see Cengage right now. And what we're going to be working on again is problem 10-5B. In this problem, we're going to do some journal entries. And so we're going to always read your instructions first, because there's always important information that you need to know about the problem. So the following transactions and adjusting entries were completed by Robinson Furniture Company for a 3-year period. All are related to the use of delivery equipment. The double declining balance method of depreciation is used. So in our first journal entry, what we're looking at is on January the 8th, we are purchasing a used delivery truck for $24,000. And it tells us that we paid cash for that truck. So all you have to do is go to your journal. We're going to start with our debits first. And because we purchased a delivery truck, the delivery truck is the name of the asset that we will be using. Because the cost of this asset was $24,000, we're going to debit, or we're going to increase that asset by $24,000. Since we paid for the delivery truck with cash, our cash, which is an asset, is decreasing. It is also decreasing by the amount that we have paid for this vehicle, which was $24,000. This is your first journal entry. On March the 7th, we paid a garage $900 for changing the oil, replacing a filter, and tuning the engine on the delivery truck. These are what we call regular maintenance charges, and they are what we refer to as revenue expenditures. And so we're going to record this as the truck repair expense, because expenses have normal debit balances and increase on the debit side. We're going to debit our delivery truck expense for $900. We're also going to, in this transaction, credit our cash, because it specifically tells us that we have paid an amount for that truck repair expense. So our cash, which is an asset, has gone down. To decrease an asset, we would credit. On the December 31st transaction, they're telling us that we need to record the depreciation on the truck for the fiscal year. December 31st is the end of our fiscal year, and since we bought that truck on January 8th, we're going to depreciate for 1 full year. The estimated useful life of the truck is 4 years. We need that in calculating our straight line rate. Remember, when we calculate our straight line rate, what we will do is we will take a 1 and divide it by the number of years in the life of the asset, which in this case, the life of the asset is 4 years. So that'll give us a straight line rate of 25%. When we're using the double declining balance method, we have to use twice the straight line rate. So I'm going to multiply this 25% times 2 to get our depreciation rate, which is 50%. You're going to take that twice the straight line rate, and you're going to multiply it by the book value of the asset in year 1. Remember, the book value of the asset is equal to the cost of the asset in year 1, as we've discussed previously. So the cost of the asset was $24,000. we're going to multiply that 50% times 24,000. And because this was an equal year, there was a whole 12 months from January to December, we're going to record this as the amount of depreciation for $12,000. It's the annual depreciation. The adjusting entry on December 31st is going to be a debit to depreciation expense for the delivery truck and a credit to our contra asset account accumulated depreciation on the delivery truck. The amount is $12,000. And so that completes year one. Now we're ready to do year two. On January the 9th, we bought a new truck this time for $50,000 and we paid cash. So on January the 9th, we will debit our truck and credit our cash. We will debit the truck because we're increasing the asset truck for the cost of the new truck, which is $50,000. We will credit our cash because we have reduced our asset account by the amount that we have paid for this truck, by the cost of the truck. So there's a credit to the cash account because it's an asset account. And we have purchased our second vehicle. On February 28th transaction of year two, we're paying the garage $250 to tune the engine and make other minor repairs on the used truck. So again, the used truck has cost us a little bit of money. It's just a little bit, so it's what we call a revenue expenditure, and we're going to record this in the truck repair expense. It's a minor expenditure, and that's why we're going to put it in the truck repairs expense. If this had been a capital expenditure, we would have debited it to the asset account. But since this is such a small expenditure, it is what we refer to as a revenue type of expense. And that expense just means we're going to record the whole amount in this year as expense. And the amount was $250. So we've got to record the amount as a debit to our truck repairs expense for $250, and then we're going to credit our cash for $250. In the next journal entry on April the 30th, we sold the used truck for $9,500. So we're selling the first truck that we purchased. The purchase price of that truck was $24,000. Notice that we've sold the truck on April 30th. This is not the year end. So when you sell an asset in between year ends, you're going to have to bring the depreciation up to the date of the sale first. Then we're going to find the book value of the asset at the date of the sale, and then we're going to determine whether there was a gain or a loss on that sale. So first of all, they're asking us in Cengage to record the depreciation amount that we have to bring up to the date of the sale. The depreciation entry that we would record is just like our adjusting entry. It really is an adjusting entry. It's just done in the middle of the period right before we are going to sell our asset, because we need to know what the book value is at the date of the sale of that asset so we can record a gain or a loss. So we're going to debit our depreciation expense and credit our accumulated depreciation on the delivery truck. Now what you have to do is you have to figure the amount for a partial year from January 1st of year two all the way up to the date of the sale, which is April the 30th. So what that tells us is that we've got 4 months that we have to depreciate this asset. Because we're using the declining balance method, what you have to do is determine the book value and then base the depreciation on that book value that was at the end of year 2. So the book value to start with in year 1 would have been equal to the cost of the asset, and the delivery truck cost us $24,000. So I'm going to record in my calculator the cost of $24,000. I'm going to subtract out my accumulated depreciation at December 31st, which was $12,000. That will give me my book value of $12,000 at the end of year 1. That book value will need to be multiplied by twice the straight line rate. The straight line rate was 25%, and we multiplied it by 2 to get twice the straight line rate of 50%. So 12,000 is going to be multiplied by 50%. What that would do is that would give you the annual depreciation, but this is not for a full year. It's only for 4 months because we're bringing the depreciation up to the date of the sale. So we have to add to this a fraction amount of 4 months divided by 12 months, and that will give me the amount of the depreciation that we have to use to bring this up to the date of the sale. The depreciation was $2,000 for 4 months, from January to April 30th. And so at this point in time, now we need to calculate a new book value at the date of the sale. To determine the book value, we still take the cost of the asset, which was $24,000. But this time, we're not going to subtract just the $12,000 because that was what we had at the end of the year. We're going to have to add the two depreciations together to get the total amount of the accumulated depreciation, which is $14,000. That $14,000 is the accumulated depreciation at the date of sale. And so when we subtract that, that will leave us with $10,000 as a book value. What you have to do is find the book value at the date of the sale, which is $10,000, and we need to compare that to what we're selling it for. Notice the book value was more than what we sold it for. We sold it for $9,500. So there's a difference of $500 that we have lost. That loss goes into a loss account that we call a loss on the sale of the asset. So we're going to have to record that loss, which is the difference between the book value at the date of sale and the amount that we sold the asset for. So we're going to back out $9,500, and what that tells us is that we have a $500 loss. So when we're recording the sale, first of all, what I would suggest that you do is you would most likely debit cash. In this case, they didn't give me an account called cash, so I went to my second debit that I would normally do, which would be a debit to the accumulated depreciation. When you sell an asset, you have to reduce the accumulated depreciation off of your books for the total amount of the accumulated depreciation. Remember that you had depreciated this asset once on December 31st for $12,000, and then you depreciated it again on April 30th for $2,000. The total of those is $14,000. that would be debited to the accumulated depreciation. You would also debit, this time they gave us a cash to use, so the cash amount would be what we sold the asset for, and in this case we sold the asset for $9,500. So cash is going to be debited for $9,500. Also, we determined that there was a loss on the sale of the asset. What you have to remember about losses is that they're treated like expenses. They're going to go up on the debit side. So the amount of that loss we calculated was $500. Remember, it's the difference between the selling price, which was $9,500, and the book value at the end of the life of the asset, or up to when we're getting ready to sell it. That's what I should have said. So the book value at the date of sale is going to be compared to the price that we sold it for. In this case, there was a loss, which would be debited because losses are treated as expenses, and the amount would be $500. My credit would be to my delivery truck for what it originally cost me. The cost of the truck was $24,000. So we're going to credit the truck for $24,000. What this does is it removes the truck off of our books. We no longer have the used delivery truck. We took the accumulated depreciation off of our books because we no longer have a used delivery truck. We sold it. Then we debited our cash for the selling price, and then we had to determine the loss on the sale of the asset. There's also a spreadsheet that I can share with you on how we determine the calculations for this. And so I think I'll wait for just a minute or two and show you those calculations so you can look at them all at one time if you want to when you're reviewing. On the last transaction in year 2, they want you to record the depreciation for the new truck. And it had an estimated residual value of $12,000, which is just there to let you know that we cannot depreciate below the scrap value or the residual value of $12,000, and that it had an estimated life of 8 years. So what we'd have to do when we're determining the depreciation for the new truck in the first year is we would have to first determine twice the straight line rate. And to do that, remember, we have to determine the straight line rate first, which will be 1 divided by the number of years in the life of the asset. In the new truck, our estimated life was 8 years, so we'll take 1 and divide it by 8. Notice this gives you 0.125. This is our straight line rate, but you have to multiply that rate by 2 to get twice the straight line rate. Therefore, we use that twice the straight line rate when we're calculating the declining balance method. Our depreciation rate for our second asset, the new truck that we bought, is 25%. So at the end of the first year, we're going to multiply that 25% times the cost of the asset, which is equal to the book value of the asset. The cost of the asset was $50,000. So 25% times 50,000, 50,000 times 25%, excuse me, will give you 12,500. That's the amount of depreciation that you would record for the full year Because you bought that asset in January, you've held it until December, it's a full year's depreciation. We will debit depreciation expense and credit accumulated depreciation for $12,500. The last year, we purchased yet another truck, another new truck for $58,500, and we paid cash for it. So we now have two trucks available to us. We're going to debit our delivery truck and credit our cash for what it cost us. It cost us 58,500. Our next transaction was on September the 4th. We sold the truck that was actually purchased on January the 9th. They're selling the truck that we bought for $50,000, and we're selling that truck on September the 4th. The last time that we depreciated that truck was at the end of year 2. We depreciated it for a full year. So when you sell the truck, the first thing you need to do is bring the depreciation up to the date of the sale. So the last time that we depreciated was on December 31st. We're selling this truck on September the 4th. So from the months of January to September the 4th are going to be 8 months. You've got to depreciate it for an additional 8 months. You might remember that when we purchased the asset, we bought the asset, the second truck, for $50,000. We would subtract the depreciation at the end of year 1, and that depreciation at the end of year 1, or actually at the end of year 2 since it was bought in year 2, the depreciation was $12,500. Subtract $12,500 from the $50,000 to get the book value at the asset at the end of the second year. Or it's at the end of year 2. It would be the first year that this is fully depreciated. So 50,000 minus 12,500 will leave you with the book value at the end of the first year of the life of this asset. That book value would need to be multiplied by the depreciation rate. Twice the straight line rate was 25%. What this will do is it will give you an annual amount of depreciation. We don't want an annual amount of depreciation. We're not through yet, so we'll have to multiply the depreciation rate of 25% times 8 months divided by 12. That 8 months means that we are bringing the depreciation up to the date of the sale. And because we had depreciated at December 31st, from January to September when we're selling this asset, we have to record the depreciation amount. We're bringing the depreciation up to date by debiting depreciation expense and crediting the contra asset account accumulated depreciation. The amount that we're going to use is $62.50. That's the accumulated depreciation or the additional depreciation that we're using for the months between January and September. So up to the day of the sale, we have to depreciate. And this is the depreciation entry up to the date of the sale. Remember that when we credit accumulated depreciation, we're adding to what we already had. In the last transaction, we credited accumulated depreciation for $12,500. So we're going to add $12,500. We're going to add $12,500 and $62.50 together to get the total amount of the accumulated depreciation. We now need to find a new book value at the date of the sale. So we'll take the cost of the asset. The cost of the asset was $50,000. We're going to subtract the accumulated depreciation to the date of sale, which was $18,750. That will leave us with our book value at the date of the sale. The book value at the date of the sale is $31,250. We have to compare that to what we sold the asset for. We sold the asset at $36,000. So there's a difference between what we sold it for. We sold it for more money than what the book value was. Compare the selling price to the book value. The difference between those is a positive amount, or it is a gain for the difference between $31,250 and $36,000. It leaves us with a gain of $47.50. So we need to know that before we create our journal entry, because gains are increased on the credit side. We know we got a credit to a gain of $47.50. Now remember, when we sell our asset, we will debit our cash for the amount that we sold it for. In this case, we have sold the asset for $36,000. So we'll debit cash for $36,000. Our accumulated depreciation on the delivery truck would also be debited. It would be debited for the total amount, the balance that is in the accumulated depreciation. The balance comes from the $12,500 plus the $62.50, which amounted to $18,750. The credits will be a reduction of our delivery truck. We're going to subtract, or we're going to credit the cost of the delivery truck out of here, and our delivery truck cost us $50,000. Remember, this was the second truck that we had purchased. We're also going to credit our gain, $47.50, and that was the difference between the selling price and the book value at the date of the sale. So that's the journal entry we would create at September the 4th. I know these are lengthy calculations, so I'm going to show you in just a minute your Excel spreadsheet, just in case you need to look at the calculations again. On the last journal entry at December 31st, we're recording the depreciation on the remaining truck. Well, we only have one truck left because we've sold two of the three that we bought. The third truck we bought for $58,500. It has a residual value or a scrap value of $16,000 and a useful life of 10 years. When we're calculating depreciation using the declining balance method, we have to first calculate the straight line rate. To do that, I'm going to take a 1 and divide it by the number of years in the life of this asset. The life of this asset was 10 years. What that will give me is 10% as the straight line rate. Because this is double the declining balance method, we have to multiply this straight line rate by 2 to get our depreciation rate, which is 20%. We will take that 20% and we will multiply it by the cost of the asset. Notice the cost of the asset was $58,500. When we multiply that, that will give us the annual depreciation. But you gotta be careful about your dates. Look at when you purchased your new truck. You bought it in September, so we can only depreciate from September to December, which is a total of 4 months. So this annual depreciation has to be multiplied by 4 months and divided by 12 to get the partial year depreciation amount of $3,900. We would debit our depreciation expense and credit accumulated depreciation for $3,900. And this is how we would have completed this problem. But as I promised, I'm going to show you the Excel spreadsheet for the calculations. So I'm going to stop sharing this. Hold tight, it's coming. And so you should be able to see the computations for the first truck. Notice the cost was $24,000. The selling price was $9,500. The life in years was 4, and this is showing you how to calculate the straight line rate, which is 1 divided by the life of 4, which gives you 25%. The straight line rate then is multiplied by 2 to get the depreciation rate for the declining balance method. At the end of year 1, we're going to take that cost of $24,000, we're going to multiply it by twice the straight line rate, and that will give us $12,000 at the depreciation for year 1. On our balance sheet for year 1, we'd have the cost of that asset being listed at $24,000. We would subtract out the accumulated depreciation that is related to this asset, which was $12,000 in the first year, and that will leave us with the book value of $12,000. Notice this note that I've got for you in the Excel spreadsheet. It says when selling an asset, first you got to bring the depreciation up to the date of the sale. And then we're going to calculate a book value at the date of the sale. That book value at the date of the sale will be compared to the selling price. If the selling price is more than the book value, we'll record a gain on the sale. Gains will increase on the credit side because they are treated like revenue. If the selling price is less than the book value, we'll record a loss on the sale of the asset. Losses on the sale of assets are increased on the debit side because they are treated like expenses. So when you sell that asset, that first asset, the first thing you need to do is to bring the depreciation up to the date of sale. And to do that, we take the book value at the end of year one, which was our $12,000, and we multiply that by twice the straight line rate, which we calculated for the first asset was 50%. And then you have to remember to multiply it by the number of months to the date of sale. Once you do that, that will give you $2,000. You might see that in the formula that I've got for you up at the top of the screen. So the depreciation expense to bring the depreciation up to date is $2,000. We would debit depreciation expense and credit accumulated depreciation at the date of the sale for $2,000. You would then determine the book value at the date of the sale. The book value is still going to be the cost less the accumulated depreciation. Your accumulated depreciation, I've also put in a T account for you, was $12,000 at the end of year one, and then we brought it up to date at $2,000 at the date of the sale. At the date of the sale, the accumulated depreciation is $14,000. So $14,000 is subtracted from the cost to get the book value. We compare the book value to what we sold it for, and the book value was $10,000. We're going to compare it to the selling price of $9,500. As you can see, we sold it for less than the book value. There would be a loss. That loss would be debited to the loss account because it's treated like an expense. For our second truck, it cost us $50,000. We had a selling price of $3,600, and the life interest of this asset was 8 years. To find the straight line rate, we would take a 1 and divide it by the 8 years. It will give us 0.125. Remember, in the declining balance method, we have to multiply the straight line rate by 2 to get the depreciation rate. So 0.125 times 2 is 25%. At the end of year one, we will take the cost of the asset and we will multiply that by twice the straight line rate. Because this was for a full year, the depreciation expense will be $12,500. At the end of year one, the book value of that asset would be the cost minus the accumulated depreciation at the end of year one, which will give you $37,500. That's the book value at the end of year one, and this is the amount that would go on your balance sheet. When you sell this asset, you have to bring the depreciation up to the date of the sale. And to do that, we'll take the book value at the end of year one, which you'll remember was $37,500. We'll multiply that by twice the straight line rate, which was 25%, and then we will multiply that by the number of months to the date of sale. So the book value was $37,500. We multiply it by 25%, and then we multiply it by 8 months to bring it up to September and divide it by 12. This will give you the depreciation that we need to bring the asset up to date. Over on this side, I've shown you the accumulated depreciation for truck number 2. At the end of year one, it was $12,500. But then to bring the depreciation up to the date of the sale, we had to add to it $6,250. The total in the accumulated depreciation is $18,750. This $18,750 would be subtracted from the cost to get the book value of $31,250. This book value will be compared to the selling price of the truck, which was $36,000. This time we sold it for more than the book value, so we had a gain on the sale of the asset of $4,750. This gain would be credited to the gain account because it's increasing the gain on the sale of the asset. For our third truck, we took the cost of the truck and we had to determine the life of the truck. The life of the truck was given at 10 years. To determine the straight line rate, we would take a 1 and divide it by 10. That would give us 10% as the straight line rate. Multiply that by 2, and that will give you 20% as the straight line rate. To find the depreciation, we would take the cost of the asset, which is equal to the book value in year one when you're using the declining balance method. The cost was $58,500. We would multiply that by twice the straight line rate of 20%, and that would give you the annual depreciation. But because we have not held that new truck for an entire year, we cannot depreciate annually. We must find the partial year depreciation at the end of year one. So we bought that asset and we've depreciated it for 4 months this time. And so the total amount of the depreciation on truck number 3 would have been $3,900 at the end of the first year at December 31st. I hope this has helped you. I'm going to stop sharing and I'm going to stop the recording.